Hello, everyone. My name is Steven Kilger. I'm the managing editor of Feed and Grain and the host of the Feed and Grain podcast. Today, I am sitting down with Gordon Denny. He's the general manager of Gordon Denny LLC, a consulting corporation specializing in the production, marketing, and processing aspects of the soybean and grain industries. He is here to talk to me about the recent rise in the soybean crush facilities. I don't know if you noticed, but they are popping up all over the country. Each one a very expensive build and ready to take in a lot of soybeans. So I was interested in kind of what's going on in that industry, and he's happy enough to tell us more. I want to thank everyone for listening today, and if you have a topic or a guest you would like to see on the Feed and Grain podcast, please go to feedandgrain.com/podcast. There's a little button on that page that you can click, and it'll be a direct line to me where you can suggest, any topic or guest that you please. But for now, thank you for listening, and Gordon, thank you so much for being here.
So the whole reason behind this is I've been working in the feed handling and processing and the grain handling and processing and the feed manufacturing industry for 7 years now, and I've just noticed that lately a lot of soybean crush plants seem to be either being built or coming online, and I was just really interested to see your take on this important value add for producers.
Yeah.
Can you start by just telling me a little bit about what a soybean crush plant is?
Sure. So I do a lot of consulting for United Soybean Board, the U.S. Soybean Export Council. Those are my main two folks that I try to work with and focus on because I got a lot of friends that are soybean farmers. Those are the guys I like to help. And so anyway, I won't do anything that isn't positive for the U.S. soybean farmer. That's my prejudice and my upfront integrity, honesty comment. So
anyway. I like to tell people we're B2B. We're not the New York Times or anything like that. We're always on our industry side. So
yeah, you don't want to negate or talk derogatorily about your number one customers. So not only that, because it's such a tough industry and there's so many uncontrollable variables that farmers and processors and nutritionists and the whole soy value chain has to deal with. So anyway, I've got 43 years of direct hands-on experience in the soybean world. Worked for Bunge for several years, both as a soybean processing plant manager and a director of procurement, where we had to buy the beans for the processing plants domestically. So anyway, that's all I've ever done since I got out of the Marine Corps in 1980 is work in the soybean business. And even prior to that, I'm a backwoods southern Indiana hillbilly farm kid, and we had a small farm and fed actually soybean hay to our beef cattle back then. So it's put kids through college, bought houses, bought the clothes I'm wearing, food, you name it. That's soybeans are my thing. And it's a unique experience, and I don't know of anyone else dumb enough to have done both, where half my career was in the processing side of the business and the other half was in the commodity trading procurement side of the business. Those are usually kind of mutually exclusive, but I saw an opportunity to help both those entities. They usually work against one another. They're jealous of one another. They don't have mutual goals, but I saw an opportunity way back when that I can understand both sides of the equation and maybe help to get those groups to work closer together. So soybean processing plant, 61, 62 of them in the U.S. today that are operating, and they can range anywhere from 30,000 bushels a day on up to, 250, 300,000 bushels a day. And I've done some calculations there on the average size based on the company and the NOPA representation. So they cost, if you were building a brand new plant today, it's going to be $350 to $450 million. So it's an expensive undertaking. I think the industry is spending $5.5 to $6 billion over the next 3 to 4 years to get new processing plants built to increase the crush capacity, and the demand is primarily coming from the renewable diesel and the sustainable aviation fuel trends that initiated in California, but they're now, because of the sustainability, because of the carbon intensity, because of the low-cost fuel standard or low-carbon fuel standards, all those things are going to push us away from fossil fuels more sustainable, renewable, greener fuels for both vehicles and airplanes. So that's the real impetus, and it's one of those things where it feels like ethanol back 20 years ago or so, or 25 maybe. There's 4 things the government can do to create artificial economics to incentivize new companies. You can mandate it, you can give tax credits, you can use tariff protections. Gosh, there's one other I can't think of offhand. That's along the tax credit line. But anyway, we did it for ethanol, and now that's kind of dying out a wee bit and probably has seen its heyday. So we're shifting over to the renewable diesel and the sustainable aviation fuel, and we're burning food oils, food-grade oils like soybean oil or canola oil or palm oil or something that can be converted to having a similar molecular structure as petroleum oils. Yeah, credits, mandates, subsidies, and tariff protection was those are the 4 things I tried to remember that the government is doing to get the incubation of new companies spurred along. There's 2 things that the soybean industry reacts to: fear and greed. And FOMO, fear of missing out, is a huge incentive for soybean processors. And the big 4, and it's not A, B, C, D, it never really was domestically. It's ADM, Bunge, Cargill, and Ag Processing. AABC would be the proper acronym. Dreyfus only has 1 domestic plant. They do export lots of stuff. They trade lots of stuff. Argentina and South America-wise, they're big, but in the U.S., it's AABC. So those 4 guys control about 70 or 75% of the U.S. domestic crush. That percentage is probably going to come down in the future as we have new entrants into the industry, even though all of those companies are expanding or building new plants. But they're only doing it to provide soybean oil to the refineries that will provide renewable diesel in those states that have mandated it. And there are several of those. Besides California, there are others that are tagging along. The soybean meal is going to be the real problem. If we increase capacity, and I think my projections show about a 28% increase in crush capacity in the next 3 to 4 years, the oil can go away. That's not a huge problem because the demand is going to be there. The refineries are already converting over. That's going to be taken care of. But the soybean meal, and you can't really store soybean meal. It takes up lots of volume. It's not easy to handle once it sets for a while. So getting rid of the soybean meal is going to be a significant issue and opportunity. We do increase consumption of soybean meal every year, but this is going to be a cathartic jump in production. So it's going to take some adjustments in the industry. We're going to have to export more soybean meal. We're going to have to export more poultry, and we're going to have to grow the poultry industry in the U.S. to consume more soybean meal. We would like 65% of the soybean meal produced in the United States today goes into something with a feather, a broiler, a layer, or a turkey.
Okay.
So feathers are the number 1 friend of soybean meal in the United States. Pork consumes, depending on the year and exports, 20 to 24% of the soybean meal that is produced in the U.S. With China, exports on pork are down. China is kind of self-sufficient. Their pork processors have good margins. So we could get to the point where our soybean meal is going to... China has always bought beans from the world, from both Brazil and the U.S. I think in the future, we could see China starting to import soybean meal from the U.S. because the values will be so low, so inexpensive. In the past, Argentina has been the number 1 soybean meal exporter in the world in a big way. Brazil exports beans, U.S. exports beans, Argentina exports soybean meal. They have differential export taxes, that's the way the industry is set up. So over the years, but now Argentina is starting to shut down some of their crush plants, and their crush plants are much less efficient, and they operate at much lower run rates, meaning U.S. plants will average around 92% of maximum crush capacity. Argentina may be at 55%. So, and it's a high fixed cost industry. You want to run as many bushels of soybeans through your plant as possible to keep your fixed costs low. So anyway, so I think the U.S. will take the place of Argentina, and we're going to have to export. So anyway, big expansion, lots of meal, lots of changes, an unprecedented amount of capital being spent and invested in soybean processing. The main impetus is renewable diesel that started in California, now followed on by sustainable aviation fuel, and the new government legislation that has recently been passed will continue to fund, mandate, subsidize tax credits, tariff protection, all those type of things to ensure that it's successful. They're incentivizing, and really
fascinating, because it does seem like the U.S. at least has a real good potential to become kind of a mecca for this.
Yeah,
if we want to. I mean, we have the soybeans, and we're investing in the infrastructure. Our companies are, so hopefully we can become one of those, an exporter of both the oil and the fuel and soybean meal. I mean, obviously, soybean farmers are excited about this. Is it just because it's another market to sell their soybeans to, or are they getting a premium if they sell to a facility, soybean crush facility, or just kind of the more markets better?
Yeah, well, no, more demand is better, I guess, and then you can break the demand down because it is more places to sell, and some of these plants are being built in processing deserts, meaning we have not had the crush capacity needed in certain areas of the country. So we're now filling in those gaps in the soybean processing crush industry, and this renewable diesel trend has started that. But they both see increased demand. They see a lower cash basis. Their local cash basis will be much better. We're going to probably see increased soybean plantings and acreage in the future. They'll have less transportation tied up to get their soybeans taken to a premium market. Mm-hmm. Processors operate around, typically 24 hours a day, 7 days a week, times 350 days a year. So the demand is very steady. It's not like the export demand that can fluctuate seasonally with South America. Okay. Domestic processors provide a steady, regular source of demand. And right now there are people in the United States paying $2.25, $2.40 a bushel over the November futures in Chicago.
Oh wow!
So they didn't plan well. That's a unbelievably high cash basis, even though the markets are inverted in Chicago. But somebody didn't plan ahead well. If I'd been the soybean buyer at this point and had to pay that much, I'd probably would be looking for another job. But anyway, and transportation is going to be a huge issue in the future, particularly on rail, as the railroads don't have. I mean, they're short crews and they're short power units. So they're going to have to, and they're probably petitioning, they're working politics in Washington to get tax breaks or incentives or something else to help them out as well. But we've lost crush this year because the railroads could not service the existing plant capacities. So we're going to need new rail cars to be built. We're going to need more railroad switch engines and crews to provide the service for all these new. A 28% increase in crush capacity, and significant. And a lot of that crush will have to be moved into the export channels. So in the previous, some of it goes away by truck, just in the local truck market. So that market is currently satiated or saturated or both, but we can't expect that market to grow very much.
No. No,
but real cars into the poultry industry, and again, poultry, something with a feather is kind of soybean's number one friend.
Yeah, well, and hopefully, the strike doesn't happen and we don't have a giant catastrophe this fall with the railroads. So.
Well, the president can step in and he can mandate, I forget what the legal phrase is, where a cooling off period, and then they are forced to come back to work, and then they introduce federal negotiators. Because it's a critical part of infrastructure with food prices and everything else the way they are. I'm sure that if he's awake, that Biden will force something to happen.
Yeah, well, let's hope. I'm sure he will, because we really can't. Well, let's face it, it's been a battle trying to get the railroad companies to update infrastructure in cars and get more and more.
Right.
While they're trying to run at the lowest possible cost that they can. So.
Yeah, I forget what it was called. And the guy that instituted it a few years ago just died recently, and he was a CEO for a couple of different railroad class ones. But it was the least cost formula where it was scheduled service, and you have to line your cars up. We're coming in every day at 5 o'clock to pick up your 50 cars of meal or oil or whatever. And if you're not ready, then we're gonna leave. So they improved their efficiencies and dwell times and car turns and all that. But the customers bore the cost. It shut plants down if they'd have a railroad problem somewhere. Chickens that went hungry. So, but I think we're going to have to get away from that old mentality of, they have a monopoly, but the government's going to have to make sure that monopoly facilitates U.S. production and trade and food costs and helping to feed the world. So that's one thing I would think the key phrase maybe is that soybean oil for renewable diesel is going to subsidize soybean meal prices. So I think protein in almost every form, and that includes chicken and pigs, and beef really doesn't. Beef eats 7 or 8% of U.S. soybean meal production, and dairy is another 7 or 8%. Aquaculture is next to nothing. It's 0.7%. So oil in renewable diesel and sustainable aviation fuel will subsidize the price of protein. Therefore, I think helping to feed humans, I don't think we're starved for fat in the world. I think we're more starved for protein. So in that respect, I can see protein in all forms, and even the artificial meat, whatever term you want to use for Impossible Burger and Beyond Meat and all that vegetable meats. I see protein in most every form getting cheaper in value, cheaper in price.
Well, that would be a welcome relief at the grocery store, huh?
Yeah.
Certainly hasn't been going that way lately.
No. What were we up to? 12% at the groceries and 8% in restaurants over the last year. So, yeah.
Yeah. Well, you've answered all the questions I had. I want to thank you so much.
Sure.
It's great talking to you. It's an industry that we haven't covered enough, and I really want to continue to expand our coverage of it, especially as it becomes more and more important, and we start having more and more soybean meal that we will be getting added to animal feed and things like that. So that's awesome.
Absolutely. Totally agree. All right. Okay. Thank you.